Hi everyone and welcome back to A Smarter Way to Retire. I'm Tony Leonardi, your certified financial planner professional here in Connecticut to guide you to a confident retirement. Last week we dove into the One Big Beautiful Bill Act signed on July 4th and its game-changing tax cuts. This week we're unpacking what's moving the economy and how it ties to your retirement, both the opportunities and the risks. So let's get to it. Before we get started, I know that we are smack dab in the middle of summer vacation season. So many of you may be tuning in from your cars on the way to the beach. I'm technically on family vacation this week myself, this week and next, but I returned today to my office just for the day to clean up some loose ends and to record this for you. And I'll be back on the beach tomorrow. So if you're on vacation, I hope you're enjoying your time and you're getting some great weather. Last week, I mentioned a couple of surprises that I was planning, but I couldn't give much detail because I didn't want to ruin the surprises. Well, the 4th of July weekend here at our house, we hosted a surprise birthday party for my sister, and we pulled it off. She was very surprised. The party went off without a hitch. We had great weather. Everyone had a great time. The food was fantastic. I didn't have to cook. My niece had the party catered and hired a bartender. So I was able to enjoy myself along with about 20 guests from my sister's birthday party. This week, as you're listening to this, we will be in the middle of a surprise engagement party for my son, Tony. He's my oldest. He got engaged recently, and he's flying into Rhode Island this weekend with his fiance to meet up with us at the beach, and we're planning a surprise engagement party for him, a lobster bake, a real Rhode Island lobster bake, which will be happening this weekend, and I hope that goes off without a hitch as well. So congratulations to Tony and Maddie. So what's happening in the economy? First up, markets felt a jolt from President Trump's new 35% tariff on Canada, announced late last week, with fresh threats earlier this week of 30% tariffs on Mexico and the EU. Stocks dipped last Friday, with the S&P 500 pulling back from its all-time high, because tariffs can raise costs for companies in sectors like materials or technology, which many of you are invested in and have in your portfolios. Deutsche Bank estimates a 2% hit on the S&P 500 earnings this quarter, and Goldman Sachs warns 70% of those costs could mean higher prices for you. Think groceries or tech gadgets. That could pinch your retirement budget or dent your funds that you have set aside for retirement. The Spider Materials sector fund was down 0.8% recently, and the tech stocks down 0.4% last week. But here's the bright side. These tariffs could possibly bring in billions of dollars in revenue to the government, according to Bloomberg, potentially easing the tax bill's $3.5 trillion deficit. With duties on Mexico and the EU in play, that revenue could grow, stabilizing the dollar and boosting long-term market confidence. That's which would be great for your retirement nest egg. Plus, the bill's business-friendly rules like the immediate equipment write-offs could lift small-cap stocks, a favorite for many of you out there, I know. This past Monday, markets rebounded, with the NASDAQ hitting a new high, driven by tech giants like NVIDIA. Earlier in the week, the euro was climbing on US-EU trade talk optimism, signaling maybe some global confidence that could lift US markets as well as European markets. Bitcoin, which we don't recommend, but it's interesting to talk about, Bitcoin soared past $112,000 this week, its highest level since May. This volatility screams opportunity, but also caution. If you're heavy in tech or crypto, you might be riding high right now. But remember, a balanced approach, a balanced portfolio is always the key to protecting your retirement nest egg. Inflation has been creeping up a little bit. Economists expect the consumer price index to show 2.7% for June, up from 2.4 in May. The bills deficit, which is predicted, could maybe nudge inflation higher, which might erode your fixed income investments like bonds or raise costs for healthcare or travel in retirement. But on the flip side of the coin, the bill's permanent tax cuts, remember we kept rates at 24, 32%, which is where most of you are. Those tax freezes could spark economic activity. Lower taxes mean more cash for you, for your businesses. Businesses could hire more and expand, boosting GDP. The Tax Foundation notes that the 2017 tax cuts added about 1% to GDP, and we could see similar growth here, now that the bill is passed. That means higher corporate profits and potentially stronger stock prices, lifting your retirement portfolio. More economic activity could also increase tax revenue, offsetting the deficit and keeping interest rates steadier for your bonds. Globally, it's a mixed bag, I'd say. Hong Kong's Hang Seng is up 23% this year. That's nice if you're invested internationally or in that particular index or ETF. But Europe, not the same. One economy in Europe projected just a 0.7% growth this year, the slowest in the EU. If you've got global investments, keep them modest, to a modest percent of your portfolio. Use them for diversification purposes, but don't overdo it. Avoid surprises. And one last thing, there's a lot of online chatter about an emergency broadcast system shift this week tied to something called Operation Chrysalis. So what is this and why is it trending? Some claim it's a signal of big economic moves, but there's no hard evidence of that yet. For your retirement, remember, skip the rumors. Try to avoid the online noise. Try to avoid the 24/7 news cycle and stick with what we know. Stick with the facts. We know we have permanent tax cuts and market shifts that you can plan around and plan smarter. So here's how to make this week's news work for your retirement. Use the bill's permanent 24 and 32% tax rates, again, which is where most of you will find yourselves. Use those permanent tax cuts to keep more cash, potentially a few $1,000s in your pocket, maybe to reinvest in your Roth IRA or healthcare funds. Work with your CPA to tweak your 2025 withholdings so you're not overpaying and giving a free loan to the government. Stress test your portfolio. With tariffs and inflation in play again, if you're with me, we use MoneyGuidePro. If you have your own software, look at your software. Stress test your portfolio. Work with your advisor. Check if you're too heavy in certain sectors like tech or materials. Maybe shift a little bit to small cap or inflation-linked bonds for more balance. Balance is the key. Leverage the bill's business deductions like the 23% Section 199A deduction. Don't miss out on that. The bill's tax cuts could boost GDP and stock prices. If you own a business or rentals, use the Section 199A deduction to save some money, potentially thousands, and reinvest in areas where you need some balance, like small caps perhaps. Stay grounded. Ignore unverified rumors. Ignore online trends. Try not to get caught up in the 24/7 news cycle. Focus on real moves like using the tariffs' revenue potential to stabilize markets for your long-term investments. grab our free 2025 tax planning checklist at LeonardiFamilyWealthCare.com to put these strategies into action. It's packed with tips to maximize the bill's benefits and protect your retirement from inflation or market dips. So that's it for this week, a vacation week, and this week's economic roundup. Visit LeonardiFamilyWealthCare.com for our checklist and follow us on Instagram at Tony Leonardi CFP or Facebook, Leonardi Family Wealth Care, for more retirement tips. Plan smart, retire happy. Enjoy your vacation, and we'll see you next week.
Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Osaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.